Good afternoon. I'm Robyn Hall, Publishing Director of Mortgage Introducer, and welcome to our live buy-to-let webinar in association with Landbay. We're currently in day 296 since the first proper lockdown, and now in so-called lockdown version 3. We've seen many changes going into 2021, not least Brexit. And as we hurtle towards March 31st and the end of furlough and the end of the stamp duty holiday and the winding up of Help to Buy, are we sailing into the perfect storm? And it certainly looks like there'll be some choppy waters ahead. But never fear. To help us navigate our way through these uncertain times, as ever, I'm joined today by Landbay Chief Executive John Goodall and Landbay Chairman and mortgage funding expert Tony Wood. Good afternoon, gentlemen, and thank you both for joining me. Now, this is a live broadcast and we will be taking some live questions. If you do submit a question that is not answered, the team at Mortgage Introducer will, along with our panelists, seek to get it answered privately, if not on the Mortgage Introducer website itself. But to start us off, Brexit. The UK formally left the EU at 11 p.m. on December the 31st last year, and already it has thrown up a raft of issues, from ham sandwiches being confiscated from lorry drivers trying to enter Europe to tariffs on bananas arriving from Ghana. But Hikmat Aziz gets straight to it and wants to know how Brexit is going to affect the UK housing market, while Christopher Banks Walker wants to know more about the macro detail and whether the economy will contract following Brexit or continue as it is. Tony, what do you think about this then?
So starting off with a small question then.
Absolutely.
Well, I'm pleased to say we did get a deal, didn't we? It was 11th hour, but it was certainly better than nothing. But it was a trade deal, and obviously the glaring omission was anything for financial services and banking in the city. And when you think that the city comprises 10% of all UK GDP and something like 11.5% of all taxation comes out of the city, it's a big hole still to be fixed. So there are ongoing discussions on this, and there are moves to try and get some sort of memorandum of understanding in place with the EU by March. Which will be really, really good. So there are things still to be sorted. But when you think we've had 3.5 years of treading water after the vote to get out, apart from what happened with COVID, so to have some certainty that we can get on with things is good news, and sure, we can improve it. But right now, I think COVID is the bigger issue. It's not Brexit. I think Brexit will be neutral to the housing market broadly, but COVID less so.
Well, yeah, I'd agree with that. I think in terms of the second part of the question, in terms of the economy will contract, well, I think one thing that is highly likely for this quarter is the economy will contract. And obviously, as Tony said, that's down to COVID. So trying to strip out whether Brexit has any impact on that is extremely difficult, and obviously the major reason will be COVID. But on a positive side, once we are vaccinated, that there should be that sort of COVID bounce. Brexit, obviously, it will have a longer term impact to the economy, but to what extent we don't know. I mean, there will be some positives for it, there will be some negatives, and it slightly depends on how the government decides to use the positives, or the potential positives, I should say.
Yeah, Brexit does throw up a couple of niggling issues, though, and people are quite concerned still. I've got a question here from Yvonne Cook, who wants to know whether you think there'll be a problem for clients who are EU citizens buying a property in the UK. And certainly on a similar theme, Victor Goring wants to know, now that we're out of Europe, does that mean, do all mortgage applicants now need full rights to remain here or have a UK passport to apply for a mortgage? You see, there is still some confusion. Do you have any thoughts on that?
I think for EU nationals that have been here or were here last year before we left the EU, I think the assumption will be that they will be able to get indefinite right to remain, and I think most lenders will look at it that way. I think that's different, obviously, to those people that haven't lived here and they are coming here now, if they can get a flight or ferry with lockdown, but they're coming, and then they are effectively a foreign national. and lenders will have to take a different view on that, because they don't have, as it stands, will not have indefinite leave to remain. So I think for EU nationals already here, I think it will be in most cases the same, and nothing changes. But for future EU nationals coming, I think it will be different.
I think it's going to boil down to ultimately boils down to two things really. One is, can you identify the person properly, KYC, and the other is going to be their income. Okay, it's a credit risk decision in the end, and so can you validate their income? Is it going to be reliable, and so on, whether they're based in EU or whether they're here. So, yeah.
COVID is obviously is the biggest issue, but it does intertwine with Brexit in many cases as well. So now the topic of HMOs is one, and what impact Brexit will have on that aspect of the market has been incredibly popular. Gianluca Bertolino from Your Mortgage Experts says that in London, the HMO sector relies a lot on leisure, hospitality, and the lower paid service sector. He wants to know whether you expect the economic impact of lockdowns and the new visa rules from Brexit to result in a longer-term structural reduction in rental demand for HMOs, and where do you see that market going in the future? Tony, HMOs and Brexit?
Well, it also, another sector it applies to is young professionals. And yeah, there'll be some downside fears, but I could see the market for HMOs being positive actually, because what are the reasons people move into HMO properties? One is to meet people. It's affordability if they can't afford to go it alone in owner-occupied or own-rented properties. Convenience, flexibility working. So you could argue that actually the market's going to be stable to demand increasing rather than decreasing. And I was looking at the press actually. I've noticed only today, or was it last night, certainly some big established buy-to-let players in this market have come out with expanded products in the HMO and the multi-unit sector. So I think my more positive view on prognosis for HMOs is probably shared with some of Landbay's fellow lenders, I would say.
Yeah, and on that point, again, like Tony, I question the assumption around HMOs, relying sort of solely on lower paid service sector and leisure hospitality. As Tony says, you'll have young professionals, you'll have NHS workers who probably got the securest jobs in the country right now, and lots of others. So I think there's quite a broad mix, as well as obviously students as well, and that's obviously another sector that people had concerns about potentially June and July last year, but haven't come to pass so far. So no, I would agree, and certainly from our perspective, we lend on HMOs and multi-unit freehold blocks, but for HMOs, we've seen consistently strong demand, not just over the last few months. So I agree with Tony. I don't think that sector is going to be negatively affected.
HMOs, one aspect of the market, obviously it is wider. Rishi Pancholi from Time and Tide Commercial Finance reckons that with freedom of movement ending, he's a little bit worried what the effect of the overall rental market would be, with less EU migrant workers coming to the UK for seasonal and short-term work. Who, well, again, they could mainly be staying in HMOs, but is this, this is more Brexit than COVID. Is that going to be a big issue, do you think?
I'm not so sure. I mean, people forget that, for the last 4 or 5 years, there's been more migration from non-EU countries into the UK than EU. So just because we've ceased freedom of movement, it doesn't mean we're stopping immigration. And so I still expect we will get migrants from the EU and from non-EU, and they will work in all different sorts of sectors as well. So I'm not really convinced on that argument. I think there's a different argument short term around COVID and the hospitality sector, et cetera, which is different to workers. So I think you could see some short term stress in that part of the rental market, because obviously the hospitality sector is closed. But actually, let's assume that we're opening up in the summer and we get through that. I still think we're going to see strong demand there.
I'd agree with that. I think young professionals are still going to have a demand for these properties. Hospitality, yes, it's under pressure at the moment, but we don't know, do we? But once we emerge from COVID, or start to emerge from COVID, and the hospitality sectors get back, I think things could sort themselves out quite quickly. So I would say they're bigger issues than the sort of transitory sort of EU workforce that we might have had, and those effects on the HMO market. So I'd be more positive about it.
Well, leaving that to one side, are there any other issues we could expect to arise from Brexit as a whole? Paul Singh from PSR and industry consultant Peter Charge, they want to know your thoughts on the wider implications Brexit may have, but also how COVID-19 and landlord tax changes might shape the future of the market. Obviously, we have covered a bit about Brexit already, but overall, what do we see happening?
Well, so fundamentally, if the UK is still open for business, as Boris and Rishi sort of say it is, or will be post-COVID, we are going to attract labour from around the world, whether that be not other EU countries or non-EU countries. And the same is true for students as well. And again, as Tony said, assuming the City of London remains a financial centre, it is still going to be a magnet for workers. Now, whether it is as much of a magnet as it was 5-6 years ago is a point of debate. But still, that people will still want to come and work here, not just in financial services, but in technology industries, in biotechnology and other industries as well, and the creative industry. So I still think that's there. And as long as the UK government has a pragmatic immigration policy that allows people to come and work here, whether that be for 2 years, 3 years, 4 years, or giving residency, then I think that the buy-to-let market will thrive, as will the rest of the economy. And separately to Brexit, I mean, again, we have seen a situation where it will be harder, unfortunately, because this crisis, for certain groups to get on the housing ladder, whether they be because they're self-employed, whether it be because they have smaller deposits, and so they are going to need to stay in the rental market for a little bit longer as well. So that's obviously a sort of direct impact of COVID. Landlord taxes, I think we can probably talk about that a bit later. I mean, I think the whole economy is going to get taxed at some point. To what extent they fall on the landlords versus other sectors, who knows? But yes, the assumption is everyone's going to be pay more tax in a couple of years' time.
Yeah, I guess we're going to find out more in March when Rishi does his statement. But Tony, do you have any immediate thoughts?
No. Well, I'm sure we'll come back to this, but I think taxation, I always worry about the Chancellor raiding the buy-to-let market. And the obvious place is stamp duty, isn't it? Not stamp duty, CGT allowances. We're going to have to wait and see. I mean, it's pure speculation, fear and worry. I guess we've all got it, but he's going to have to do something to start to repair the massive government borrowing deficit that he's got at the moment. So, yeah.
Well, it's something we probably will come back to later, and certainly something we've all got something to look forward to in March. And going back to COVID-19 then, Vishal Vyas wants to know, what impact do you think the latest lockdown will have on both the lending market, but also advisors' jobs? Do we see any decline in, advisors leaving the mortgage market and buy-to-let market, perhaps?
Well, the market's very strong now. I mean, from our perspective, we're significantly up on last January. Again, it's early days in the month, but we're far busier than we were last January, which, if you remember, post-election, there's quite a lot of confidence in the market then as well. And I know other lenders are the same. So I suspect certainly in the short, medium term, whether it be lenders or whether it be advisors, they're extremely busy now. I think there's inevitably going to be, some of that is down to the stamp duty, but there is, I'm sure we'll come and talk about that later, but there's still a massive remortgage market. The buy-to-let market alone is 270 billion outstanding. If 12% of that refinances every year, then that's 32 billion of gross lending per year. And that equates to someone remortgaging every 8 years. So the size of the market means that actually the market will continue to grow, even if that purchase number doesn't grow as fast as it has done.
Yeah. Tony, do you have anything to add to that?
Well, I sort of agree. I think there's very little doubt that the stamp duty effect has had a lot to do with it. I mean, there was pent-up demand. It was a very strange year last year, wasn't it? That the market just suddenly stopped, then restarted again, and we came out of the first lockdown. And I think there was some euphoria of coming out of it. The fact that we were doing some normal things, there was demand for house moves and house purchase anyway. And then the stamp duty thing came along, and it sort of has definitely stoked the market up. But when it ends, we're going to have spring coming at around about the same time. So we're in a fairly gloomy place right now, and I'm hoping that 3 or 4 months down the line we'll be getting into a bit of a less gloomy place. And so you're going to see positive offset. Hopefully, you're going to see positive offsets of coming out of lockdowns. Some sort of end in sight that is difficult to contemplate right now at a time when we lose stamp duty. So I think we're going to have a glitch. So my expectations are we're going to see a reduction in housing transactions and mortgage activity come April. And sure enough, given there's this sort of cliff edge we're all facing at the moment, it's going to be a struggle to get all those deals done before the stamp duty cliff edge cuts in. There'll be some disappointed people. I think there's no doubt about it. So it'll end. We'll all be exhausted. There'll be a little bit of a rest, and I expect the market to take off again.
Yeah, I think I think stamp duty is obviously it's going to be a big issue as the months draw closer. But talking of market gloom, Eddie Eason wants to know what effect do you think the extended lockdown and further COVID-19 restrictions will have on the housing market in 2021? There are new restrictions expected to be announced this weekend. I think they are talking about closing estate agents. Where do you see?
Yeah, so I've seen those. I've seen that Scotland has sort of stopped things like click and collect and various other things like that. I mean, obviously the housing market is open, and as I said, I think all chains in it, all parts in it, whether that be brokers, lenders, valuers, conveyancers, are phenomenally busy, and business is strong. And in terms of anything that obviously reduces or makes it harder to get access to properties, and whether that be because residents are shielding or valuers actually don't feel safe going to properties, obviously slows that down, and that's no one's fault. And at the same time, we've got to remember that all these people, whether they be valuers, whether they be brokers, whether they be lenders, they're dealing with homeschooling and lots of other things as well, and they're all sort of working phenomenally hard at the same time, teaching maths and geography and anything else that they can at the same time. So it is going to get extremely tight, and if the COVID restrictions get tighter, then as we're already seeing, completion times are far longer than they typically are, and with the combination of restrictions and the volumes in the market, that is unlikely to improve before the end of March.
Yeah.
Are either of you expecting the housing market to stop as it did in the first lockdown?
Well,
personally, I don't. I mean, I must confess, probably like most people involved in this market, when it was announced, obviously last Monday evening, that there was going to be a lockdown, constantly refreshing the government UK website to see what was happening to the housing market until we got certainty. So, obviously when it was announced, none of us were probably certain, but very quickly it became apparent that it was open. I'd be surprised if they close it totally. I mean, I think there's one thing about closing down estate agents' physical offices. That doesn't mean they can't work, they can't do viewings, etc. I'd be surprised, but again, we've got used to surprises.
I think as well, when you look at what happened in March, it shouldn't have done, but it caught everyone by surprise. And a lot of measures were put in place very quickly. They weren't necessarily thought through. And basically the whole economy was stopped. That's what it felt like. And we were all having to deal with things on the fly, as it were. And and things were eased up. But I think it was also an opportunity for the government to maybe think a bit more about which key parts of the economy just had to keep going as best you can whilst mitigating the risk of COVID transmission. And housing has been one of those that they've tried to keep going. So I don't see this as things stand, I don't see this lockdown, bad as it is and gloomy as it is, like the first lockdown. I mean, the data is a lot worse in terms of transmission levels and hospitalizations. It's quite frightening, but it doesn't feel like the same in terms of economic response, and certainly the housing and mortgage market doesn't. And indeed, we've still got funding markets operating.
But there is an overriding sense, should the worst happen, do you think we are better prepared now because we sort of know what to expect? We can, we face surprises all the time from this government. Yeah. We should be able to ride it through.
Well, we should be prepared to have new surprises come our way, because it seems it's not just the government. The government's getting surprised as much as anyone else, it seems to me. But one of the key things is the working from home and the remote working technology. I think smaller, more modern businesses probably, ironically, found it a lot easier. Lambay didn't find that too difficult. I can imagine that was a huge issue for a lot of the bigger, more complex, established banking businesses. But for better or worse, we've all had to deal with that. So that's all in place and working. It may not be ideal, but we can deal with it. So I think we are better prepared.
I think the other thing as well is last time the funding markets just closed up, and that was because obviously funders were expecting house prices. Well, they didn't know what to expect, but the assumption was that house prices were going to drop, and we were going to enter into a severe economic depression. And while obviously the impact on the economy has been significant, I think going through that, even if we did go into lockdown, I think funders would feel confident that actually suddenly, particularly with the vaccine out, that this is going to be a short-term thing. House prices aren't going to suddenly fall off the edge. So funding markets would potentially, I suspect, would stay open because actually the fact we've been through it and proved that house prices are not likely to fall materially as well. So I think that means that would give a bit more support to the market that existed, that didn't exist last time.
Okay, we've had quite a few questions coming in that are expressing some concerns about delays to valuations and conveyancing as a whole. This could be delays to searches and issues with the Royal Mail and the postal system. Not everything can be done online. Physical copies are needed, need to be signed, witnessed. How much of a problem do you think this is going to be in terms of valuations and delays with the, on the conveyancing side?
So first of all, on the valuations, I think, broadly speaking, from where we sit on the main, service levels are holding up quite well. Now, there will be some cases where access is harder. And so I'm not saying they're holding up well all the time, but for the majority of cases, they're getting valued in a decent time from instruction. But as I said, there may be certain cases where there's certain areas of the country where a number of valuers are decided not to visit properties, or the residents of that property don't want to let people in because they feel that they've got COVID symptoms or whatever. So you will get a small number of cases where a valuation is being materially held up, was causing a problem. But for the vast majority, from what we're seeing, we're not seeing any material difference. Conveyancing, I personally think that's working from home probably as well as any of us are. I mean, let's be honest, it's not perfect, but there's a huge amount of work going through the pipelines that people weren't expecting, or sorry, they weren't expecting this time last year. And because of that March deadline, and again, local authority searches we know are taking longer. So I think there are delays there, but that is volume related, probably more so than lockdown related.
Yeah.
Okay, just on valuations, just had a question coming from Gwyn Matthews. Who says HMO valuations seem more of a random event than residential valuations. Do you favour a particular surveyor company? John?
Well, we do use a company, we use a panel manager that do specialise, and a large part of the business specialise in HMOs. So we use Allied, so they won't mind me saying, who do a lot of both commercial and things like HMOs. as well. They do often need a different approach to them.
Okay, and just on that as well, we've got another question here, or it's a point really, from Tanya Cilia. She says a client contacted her today saying they've read that people are being advised not to move as tighter restrictions come in. Do you think that's going to result in more people expanding their existing property or getting larger extensions? And with people being advised not to move, Carol McFadden asks, do you think it's going to become easier to source products for buy-to-let purchase mortgages with tenants in situ?
There's quite a few questions there. Tenants in situ, in short, it depends on how long those tenants have been there, whether they're on ASTs, and there's a lot, without getting down to too much nitty-gritty, it does complicate things. It's not necessarily a stopper, but it does vary. It does change, and different lenders will take different approaches.
Okay, and Tanya's just said, do you think we're going to see an extension on mortgage offers? Sorry, from lenders. So this maybe even ties into the stamp duty deadline. So if you've missed the stamp duty deadline, is the offer going to run out? Will the lender extend the mortgage offer? Do you see that happening?
No. So I think, and again, I can't talk for all lenders, but I suspect the approach we take is the same, that most lenders we will extend offers if we're confident that the valuation still holds up. Sometimes we'll ask for comments from a valuer whether they've got any issues with extending it, whether they think there's been any material reason why that valuation isn't valid now. I suspect most lenders take that approach. So I suspect that in most cases, getting an offer extension is unlikely to be the issue. I mean, again, there may be individual cases where that's not the case, but I think on the main, lenders will be comfortable on extending the offer if they're confident that nothing has materially changed from the application.
Okay. I heard something coming from Zanara Saeed, who wants to know, what should buy-to-let clients bear in mind with all the changes in the financial industry due to COVID-19? Obviously, lots to take in mind. As a new client, what would you say? Tony, do you have any thoughts?
Yeah, nothing's really changed, actually. COVID, Brexit, all these things, I guess they just bring the risks to the fore that are there anyway, which is, I would say, don't overextend yourself. Don't stretch yourself to the limit. Don't gear yourself up ridiculously. Try and have other incomes available in case of rental voids and other unforeseen circumstances. Don't burn through all your capital in case you need it to do work on the properties. And if you're investing in the HMO or multi-unit let sector, then make sure you fully understand with COVID what your obligations are around the rules and social distancing, etc. But key things are, don't bet everything on this. Have some other resources available.
Yeah, don't bet the farm. John, do you have anything to add?
No, I agree very much, Tony.
Yeah, okay. Now, Peter Jackson from PJ Independent Financial Services says that with less prospective tenants in the future, can you see rental income decreasing? Any thoughts on
my view, and I think I probably take a different view to Tony, is I think it's not materially. No, I mean, there was some data out from Rightmove, I can't remember if it was last week or earlier this week, about demand inquiries and demand for rental properties being 20% higher than last January. There's some data actually about how rents have been rising over the space of 2020. There's going to be some individual cases, particularly potentially in central London and certain geographies. But I personally, I think rents will hold up. Rental demand on the main will hold up. Let's say there may be some instances where that's not the case. But as an average, I'd still expect rents to be higher at the end of this year than they are now.
I think I'm probably a bit more pessimistic than John, and I'm really looking to the short term, really the next 12 months in particular, because we just don't know the effects yet of how long is it going to be, what's the duration until we can start getting employment rising again rather than, unemployment's not that high considering what's been thrown at it. And the Bank of England are saying it's not going to be more than 7% in their latest data, which is amazing, actually. Not where we thought we'd be back in March last year. But nevertheless, the economy has taken a complete pounding. And I think there's a possibility that we're going to see rents in the short term impacted in that. But I do see it as a shorter term issue until we get back to normality, really.
Well, rents being squeezed is something that's been raised by Mark Rhea. He wants to know whether you're expecting a national downturn in rents as incomes become squeezed on the back of unemployment escalating, as is expected due to the lockdown hangover. And if so, how do you think it will last? And will that add significant drag to asset values?
Again, I put my hand up to this. March last year, I was extremely pessimistic about the prospects for house prices. I thought we were going to see a massive impact on the economy as a whole and house prices, and it has not manifested itself. In fact, it's gone the other way, hasn't it? We've seen house price growth. So, and the comment I just made about unemployment doesn't look to be as bad as we thought, consistent with the government and the Bank of England's views. So, put it into context. I think if unemployment were to hit 7%, then that's double what it was pre-COVID, but historically not too bad. If we saw a downturn in house prices in the coming months, and I think it's possible post-March, I think it is possible in the short term, taken together with all the house price rises we've had in the last 12 months or so, net, it's going to even out. It's not going to be significant. So I would say house prices, my view now, is I think they're going to hold up pretty well, actually, taken as a whole. We're building houses quite strongly at the moment, but we still have a structural deficit of houses in this country. So I'm not looking for asset values to plummet, would be my view now. John, what do you think?
No, I agree. And again, I think aside from people with small deposits, so first-time buyers, mortgages are still pretty cheap. So if you can access finance, it does mean your finance is cheap. The cost of financing is cheap, which again also helps support house prices to some degree. I take the point that if rents are squeezed or rents don't go up, how does that affect house prices? Well, I don't think rents drive house prices in the same way as they do the other assets, because probably only 20% of property is driven by rental income, i.e. the rest is by home ownership. However, returns on all assets are falling. So actually the relative return on buy-to-let, even with lower rents or rents not rising as far as high as house prices, means that actually net in a super low interest world where also dividends are dropping in the stock market as well. And I really think that we are going to see over the next 2-3 years an investor switch from a search for income, a search for yield rather than search for growth. And buy-to-let still stacks up extremely well, even if in that case where rents stay flattish over the course of this year next, which I don't think they will.
Okay, I just want to go back to valuations and conveyancing and some of the problems we could be experiencing there going forward. Howard Rubin's been in touch, and he wants to know whether you think as a result of conveyancers and underwriters suffering service issues, will more lenders now offer product transfers? John, do you see a rise in product transfers on the cards?
Yeah, I think all lenders, I think it makes commercial sense for them to look at their retention policy. So product transfers, obviously being part of that, but even if they want further advances. So yes, I expect it is something that a lot of lenders are looking at, because obviously it's far easier to keep a borrower than to acquire a new one from a commercial perspective as well.
Okay. Just look briefly at the commercial side of things and the commercial rented market. Sanjay Regani from Sterling Professional Finance wants to know what you think the impact will be for the high street, with retailers seemingly closing left, right and centre, and whether this will be further impacted by the likes of, say, Cafe Nero suggesting that they wish to pay rent based on the turnover of each shop. big issues on the high street. Tony, any thoughts? What's happening here?
Well, things look pretty bleak at the moment, don't they? We've got Christmas and New Year behind us, that brief euphoria. Numbers are being spiraling out of control. It's raining out as I look out the window at the moment, and it feels pretty depressing if you want to be depressed about it all. But, you know, I think it all depends on the efficacy of these vaccines, how fast we can get them out, how effective they are. And let's not forget, we've got something like 30% of the population are expected to already be carrying immunity, having suffered from COVID itself. So things could change quite quickly. It's one of the things we've learned during this whole COVID experience. They look bleak now, but it could change quite quickly. And by the spring, warmer sunny days, you know, we could be feeling a lot better. And therefore the impact on Cafe Neros of this world, it could be very quick. So we can't, it's very hard to speculate on these things. We know things can move quite quickly and they can change in ways that we hadn't thought. It's caught us out, everyone's been caught out on this a number of times, but as things stand today, I think there are reasons to be cheerful, not that far away, which hopefully will make us think much more positively about this.
I think we've got to remember that, you know, the high street was been in decline for years, and you know, because obviously moved to online, but also out of town shopping centres or shopping malls. So that's been the case for a while. And the high street's been changing, obviously, from shops to cafes and bars and the like. Anyway, so this has potentially accelerated that further. It may well be that in 10 years' time, the high street is a very different place to what it is today, or what it was last year, I should say, even. And there's more people living there, for example, and actually people start going back to living in the centre of town because actually there aren't shops there. And again, I think that was something that was probably happening anyway, and this may have brought that forward by a few years.
Yeah. Sticking with that commercial aspect and along those lines, we've got a question coming from James Adkin. He wants to know whether you think large offices may well now be converted to residential property across the country, as those existing tenants now have more staff working from home. What are your thoughts on that? Could the conversion of office space maybe help end our lack of affordable housing?
So we certainly, you know, we're based in Victoria, and at the other end of Victoria Street, quite a lot of those offices and retail actually have moved into flats or mixed use where there's some residential as well. So I think that's already been happening. I personally, and again, this is a slightly different point, but I'm not convinced the office is dead. I think, you know, people have now been out for 10 months. I think over the summer, people think, oh, it's great working from home. You know, I can go for a walk at lunchtime around the park. I can meet friends, etc. And I think now people are probably very desperate to see work colleagues again and friends, etc. So I'm not saying that the nature of work won't change and that flexible working won't return, but I'm not convinced that actually everyone's going to be working from home 5 days a week, or the vast majority of people. I think people will, or a lot of people, a lot of firms will want to get people back to offices, maybe not in the same way as they were this time last year, but I'm not convinced that office working is over.
What about the conversion of offices to residential, though? Can you see more of that happening in the future?
Yeah, potentially. I mean, it was happening before. So, you know, and again, whether that's also true of retail and other commercial spaces as well. So I don't know. As I say, I think a fair bit of it was happening pre-crisis. So whether that just continues or accelerates, I don't know. But you know, I can't comment on.
Okay. Well, one of the consequences of, or advantages, and we've touched on it, of COVID and lockdown has been the need to work from home where possible. But it does throw some other issues as well. Samuel Daly from Spencer James Financial wants to know whether working from home is sustainable in the long term. You just touched slightly on that, John. He also wants to know whether you think underwriters would be likely to ignore the cost of a commute of, say, 50 to 60 miles for an applicant who is office-based but currently working from home. And as we return to some form of normality and vaccinations really kick in, do you think that we'll see the trend reversed, or is it here to stay? John, you touched on some of those points. Do you want to expand a little bit more?
Yeah, I'll just talk about a particular point, and then I'll let Tony give his views on the trend reversal. On that sort of underwriters likely to ignore the cost of commute. We're a buy-to-let lender, so it's not something we really look at in terms of that, what's that personal expenditure month to month, how much do you spend on the same could be true of gyms as well, that you're no longer paying gym membership. So again, that's not something that I'm afraid I can comment on. But as I said, I give my views on office, so I'll pass over to Tony on that one.
No surprise. I'm in line with you on this one. Although personally, I suspect I'm going to be spending a lot more time working from home. I've given up my office in the city, don't expect to go back full time. But let's face it, I'm not representative of the working community now. I'm an old codger. So I'm with you. I think, and I'm actually with Rishi Sunak on this, who said the other day that people are social animals. They crave social interaction. And they do, and I do. I think we all do. So I miss being in the city, meeting up with people. You can do an awful lot of functional things from working from home, but you miss out on a lot as well. When you're in an office, you just hear things from a business perspective, but actually it enriches your life a bit, doesn't it, to be with other people? So I'm with you. I think we're going to see more working from home than we did before. But I don't think that's going to be the new norm, as it were. I think it's going to be more of a reversion to working from offices.
Just a quick question on commercial before we move on to March 31st. Cameron Bowley is asking, just what is your opinion on large retail shopping centres like the Metro Centre and Eldon Garden in the northeast, which now have a very high number of empty units? Do you see these shopping centres switching from only retail and hospitality to maybe include more office spaces or even conversion to residential apartments? Are we seeing the end of large retail shopping centres, do you think?
I don't know. I mean, I live relatively near Westfield in West London, and certainly when things opened up again, actually it was pretty busy. Again, so again, I don't know, but I think again, people have over lockdown. People have, not everyone, but if you look at the savings balances in banks, people have saved a lot of money. I think roughly 4 years worth of saving was done last year. Credit card bills were cut by about 20%, as were overdrafts. And so I think when lockdown does ease, people will get out and go spend money, whether that be at restaurants, whether that be in shops, whether it be at cinemas, or sporting venues, etc., etc.
Okay. Now, with March 31st drawing ever closer, there are three big issues on everyone's mind at the moment: the end of furlough, the end of the stamp duty holiday, and the winding up of Help to Buy. Now, are you forecasting a major contraction in employment when furlough comes to an end? And what implications do you think that will have for new lending? Tony, any thoughts on what the end of furlough means?
I've trailed all this really in discussions we've already had. I'm in line. I suppose I'm in line with the Bank of England's forecast that I'm not expecting a massive kick up in unemployment. So I'm not expecting that to massively deteriorate. Phasing out government schemes and rate deferrals hopefully is going to coincide with better news on the COVID front. We wait to see, but that, as of today, would seem not improbable. We're going to have some wobbles. I think to assume we'll just move in majestic moves of the dial from high moving into a new norm. I think we're likely to have some wobbles post.
Can you just clarify what a wobble would be?
Yeah, I could see as we get to the end of March and all these things phase out, that we have a bit of a wobble in housing transactions and mortgage market. It could happen. I've put the case that says, well, it's going to coincide with better longer term news on the exit from lockdowns and COVID. Hopefully it will, but it might not. It might be a few months away. So we could find ourselves with a bit of an interregnum between these schemes going and actually the confidence that we all need that life is on track to come back to normal in the very near future, because that's what we need. We need. I saw a question from someone else raised on the chat that we need confidence. We always need confidence, and who do we look to for that confidence? Well, we have to look to people we trust. So that has to be the government, and it has to be Bank of England, who are independent of the government because they're looking at this from an economic, financial policy perspective. So we have to take all of these soundings and look to other governments as well. This is not a UK thing, and make our own minds up.
Okay, now stamp duty is the big one that everyone talks about. And both Greg Cunnington from Alexander Hall, Keith Hood from WealthSpend, they're amongst hundreds who want to know, do you think the stamp holiday will be extended in any form? And just to add to that, Kate Davies from IMLA, she says there have been many calls to the Chancellor to extend the stamp duty holiday. If he does so, won't that just kick the can down the road? Can you see him giving up the tax take, or can you see a case for abolition of stamp duty on the basis that plenty of tax comes into the exchequer from other sources if people move more often?
So there's a really short answer to this, which is no chance in them extending a stamp duty holiday. But if you look at it, if you look at the data, the mortgage market and the housing market has performed stunningly. So John said it earlier, when we were in March, things looked terrible. We had no one knew how to work from home. We were rushing through schemes, furlough schemes, payment deferral schemes through mortgage lenders. It was an emergency, and things looked bleak. And here we are, having looked at the housing and the mortgage market. It held up really well last year. So frankly, if I was Rishi Sunak, I wouldn't be, when he's got a massive government borrowing deficit that he needs to sort out and other areas of the economy to focus on. I can't really see that he'll be thinking, we must do something to further help the housing market and the mortgage market. It won't register with him. I can't see it. I'll be proved wrong on another webinar we do. I just can't see it. And I agree with Kate, actually. If you give it another extension, move it out to the end of April, it just kicks the can down the road, and we'll have another cliff edge, won't we? So,
yeah, I mean, I personally would be with Tony. I'd be surprised if they extend it. Again, I think, as I've mentioned to someone before, that the best way to make money over the last year was probably to bet the exact opposite of what they think the government say they're going to do. So, actually, they say they're not extending it, but actually, for the same reasons as Tony said, I don't necessarily think it would be it's high on their priority list. And I think, obviously, there's a lot of talk about it in the paper, not just the trade press. I noticed the Telegraph are sort of running a campaign, and there's other petitions going on. And I think the really important thing here is there is a danger that people, and whether that be brokers, whether it be their clients, they're reading so much about extension. They think, oh, it's going to get extended, it's going to get extended. And I think it's really important that lenders, intermediaries really talk to clients and say, look, at the moment, the stamp duty is end of March, and we've got to assume that's the case, because otherwise, if they start thinking it's going to get extended, they're going to have even more disappointed clients who are putting in applications later in January, early February, think, oh, it's going to get extended, we'll get it through. I think it's really important to be upfront that actually, we know there's congestion in the system, and actually talk of, oh, it might be extended, probably gives people a bit of a false sense of hope.
Good advice.
Okay, now I've got Mira wants to know whether the end of Furlough, the stamp duty holiday, and the winding up of Help to Buy will mean or will create a time to buy. And if so, how long do you think it will take for the impact of all three to filter through to the wider market? Now, he also wants to know whether we can expect an economic bounce or recovery once we get unlocked due to pent-up demand and the fact that we have all been saving money. But which outweighs the other, and why? Now, we've covered some of these points already, but Tony, what do you think?
Well, I think it's fair to say that people have really been saving a lot of money, because if you look at the data on what's known as the broad supply of money, sterling M3, it rose by 326 billion during the first half of 2020, which is massive. So some of this would have come out of government schemes, quantitative easing, liberalisation of loose monetary policy. It was there to stimulate and expand the money supply. But a lot of it is people just haven't been spending money, and maybe haven't wanted to spend money either. So we got a lot of money out there that needs spending, and actually does need spending. because that creates economic activity. Whether that's going to be on houses, whether it'll be on holidays post lockdown or new cars and things like this, I don't know. But I think as COVID sorts itself out, this surplus of savings that have built up is going to unwind, my belief. Some of it will go into the housing markets, of course.
Yeah, I agree. I think the economy will bounce back pretty strong in certainly second half of the year. There's obviously a possibility that end of March, with all these things come together, all these points we talked about, end of furlough stamp. I think furlough does run till April though, but obviously we're hitting Easter. Some of the, well, not all the restrictions will be lifted by then. Maybe very few of the restrictions will be lifted by then. We don't know. So I think Q2 there'll still be a recovery, but I think the economy is likely to sort of go sideways probably in Q2 until we get to that point where the government thinks, right, we can, broadly speaking, open up. And at what point that is, whether it's when everyone over 50 has got the vaccination, or I really don't know. But I do think we should see quite a strong recovery, but that could be summer rather than sort of April.
Okay, now just wary of the time. We've got about 10 minutes left. We've had a couple of questions coming on payment holidays. Sue Pengelly wants to know how you're considering these in relation to new applications, and Ronnie Rain wonders whether you think more payment holidays for clients could be on the horizon. John, any thoughts on you?
Yeah, so there's two separate questions there. I mean, obviously the payment holidays, actually, most people who took payment holidays took them very quickly in end of March, April, May 2020, and certainly from land-based perspective, and I know from industry data and what other competitors have been saying, that's been the case across board. That the payment requests in the second half of last year were very low, even though they're allowed, and I expect all the data I've seen that's the case now. So I'm not saying there won't be any, but actually they haven't really been a big feature in the buy-to-let market, apart from obviously in Q2 last year. In terms of Sue's question, how we consider them in terms of new applications. When people are taking a payment holiday, they are saying to the borrower, I am under financial stress, and so I need a payment holiday. So if that person at the same time is applying for a mortgage where they're saying, oh, I'm of good credit worthy, I can make the payments, there's a slight conflict there. So I think, and again, and I think that's why buy-to-let, we've typically seen lower instances of payment holidays, because people with large portfolios or multiple properties realize where they have to remortgage regularly, that actually if they've got payment holidays in place, then it does ask questions about how they can service their mortgages and potentially some new properties going forward. So I do think only take them if you really need them, and if you really need them, you're probably not looking to be expanding your buy-to-let portfolio.
Do you think payment deferrals are going to have an impact on your default level now, especially with furlough coming to an end?
So our default level, if it's ours, our payment holidays are we technically have 0 now payment holidays, or that was certainly the case as of Friday last week. So personally, I can't see it. And again, the market we serve, where portfolio landlords, etc., then I would expect it. The government's likely to keep it going until the economy fully opens up. I think anyone that was going to take one is probably taking one. So I personally wouldn't expect to see a huge increase in defaults arrears. I think, yes, there'll be a tick up in data, because anyone that was probably going to go into arrears would have taken a payment holiday rather than go into arrears, because it's probably better for their credit file. So I'm not saying there won't be any, but I don't think we're going to see anything like sort of 2008 levels of arrears or defaults or anything like that.
Okay, I want to move on to funding briefly, and what effect the pandemic has had on funding. Tony, are we more optimistic about a return to more normal markets in the long run, and if so, why?
Yeah, I think we are. I think we saw a dislocation in the market last spring to summer, but it's been steadily sort of coming back to normal, and so issuance of securitized issues are now pretty near normal, I'd say. Why? I think it's like everything else. We've all looked around and seen that economies have not blown up. The housing market hasn't blown up. And so investing in mortgage-backed securities, for example, has still been a sensible thing to do. And you have to remember, we've got 0 to negative interest rates around the world. Where do you put your money? So if you're a bank or a big fund, you could put it into stocks and shares. But actually, you could put it into government gilts, but actually you're not going to make any money out of government gilts. So I would say mortgages are a good place to put your money. They've proved to be over the years. And if you're a bank investing in these, they're low risk weighted assets, which means that the return you get, the marginal return for capital employed, it's pretty good. So I think early panics aside, which is what we all saw on a number of fronts, pretty much trending back to normal.
Yeah, and again, as we said, funds and banks are sitting on, a lot of money, a lot of capital that they have to do something with. And Tony says mortgage-backed securities have performed very well. I know there's a number of deals out there now, and the market's pretty strong. So no, that market has returned because and largely, not largely, but a major reason is because it showed its resilience, over the course of Q2 and Q3 last year.
Okay, just leaving those issues to one side, I've got a couple of more questions I want to try and get in. Rob Jupp, Chief Executive of Brightstar, says that without shared ownership on the table, is there a straight choice between the growth of the private rented sector or owner occupation? Would longer term tenancies, 5 years plus, give an environment where a hybrid product could be created? Tony, any thoughts on this hybrid product?
Yeah, well, I guess it's horses for courses. Those who want to rent, those who want to buy. Hybrids they're not only possible. I've actually seen some schemes out there with people trying to get businesses away that are forms of hybrids. And there's one that I've seen recently where it's an owner occupied with one room that is invested in and is available to rent. And you end up with an owner-occupied deal with what almost looks like an HMO in some respects. So I think you could see some of these. They get quite complicated. And my experience of the mortgage industry is it doesn't really do complicated things for very long. It tends to revert to more simple ideas. So I'm not ruling them out. There are deals I'm aware of, but I don't think they're going to be big, is what I'd say.
Okay, we've also had quite a few questions that have come in on interest rates. John Cox wants to know what your view is on rates over the medium to long term, but for the time being, I'm interested in stress tests. Do you think these will be removed for lenders, given how low the interest rate environment is at the moment, or how low interest rates are?
Yeah, so I don't think interest rates are going anywhere in the near future. I don't mean they might go up a bit, but if you look at it, we've got inflation at 0.6%, where the target is 2%. So we're so far off where the Bank of England is supposed to manage inflation to. There are no inflationary pressures to put them up at all. So first, we got to get the economy back on track and recovering, and then stimulate some inflation. We need that into the system before we even begin to think about raising rates to 0.25%, 0.5%, 0.75%. So I'm thinking in those regions, not in when it gets back to 5 to 7%. I'm not seeing that in the near term. As for stress tests, they are being looked at. The Financial Policy Committee has said that it's going to look at these, and it's going to take into account the reversion rates, given that stress or reversion rates today are so much lower than they were in 2014 when MCOB was put in and all these stress tests. So they're going to look at it, and I wouldn't be surprised if they do ease it a bit. But I was also thinking longer term fixed rates. So if you basically have a fixed rate of 5 years or more, you don't have the stress anyway. So we've already got a mechanism to alleviate the stresses. It already exists in a sense.
Okay, Andrew Duxbury from Excel Mortgage Services, he reckons that a higher interest base rate, so anything between 5 to 7%, is actually more of a risk to the buy-to-let market than anything to do with COVID-19 or Brexit. What is the biggest risk?
Well, so I think notionally that's correct in terms of long term, But obviously, if we're in an environment where interest rates are 5 to 7%, which I think I'm not convinced that they will revert there, the mean reversion. I think there's enough reasons why inflation will structurally be lower over the next 20 years than it has been over the last 20 years, for example. But in that instance, you're going to have, you'll expect inflation to be higher, and therefore rents to be going up, et cetera, et cetera. So, you know, if interest rates are that high, then actually rents and other asset values would have been going up as well as a lot. I think if we do get to that point where interest rates are meaningfully higher, and nowhere near that point, rather than the buy-to-let market, the biggest problem is government debt. The amount of debt we're taking on, the government, we couldn't as a taxpayer afford to finance even at 4 or 5%, let alone 5 or 7%. So, you know, I think that is a broader threat to the economy than just on the buy-to-let sector.
And to put into context, we got government debt close to 400 billion now, where it was sitting at 56 billion in 2019-2020. So it was sitting at 2.5% of GDP. It's now about 20% of GDP. It's massive and still going.
Just briefly, with sticking with interest rates, in Denmark, they've introduced a negative central interest rate. Besk Forowiski wants to know, if this happened in the UK, what could the impact be while looking at the UK market?
Well, yeah, it's quite interesting. I was reading something this morning on it. Even members of the Monetary Policy Committee and advisors can't agree amongst themselves what the impact of this will be and whether it's worth doing or not. So I saw Andrew Bailey sort of backtracking on this, if anything, in the press today. So the Danish market is different to ours. Its mortgages are all long-term fixed rate. They're funded by long-term fixed rate bonds. Here, our mortgages are funded by securitization, but they're also funded by retail deposits and government funding through things like term funding schemes and so on. And the key thing about zero interest rates or negative interest rates, the key reason for doing it is actually to discourage banks from leaving money with the central bank doing nothing, but to encourage them to put it to work in the economy. That's the point of it. Can you get a transmission of negative interest rates to retail depositors, which is what you'd have to do to cut mortgage rates and consumer loan rates? I don't think so. So I think there's a limit to what you can really do with zero to negative interest rates in our economy. And we don't have long-term fixed rates to any great degree here, and we don't fund them the same way as Denmark.
It's also, you know, to stimulate consumer demand. And as you saw last year, even at rates of 0.1%, it's not, people can't spend money. So by cutting interest rates further, if they go negative, as a consumer, it's not like you're going to go out and buy a car while there's lockdown on, or book a holiday properly. So, or even buy a suit because you don't need it. So you either just, or even do a new kitchen or anything like that. So, you know, people have got nowhere to spend the money, and so I think the impact of negative rates while we're in a lockdown just doesn't work. It just because the system is different.
People just take the money out and stick it in shoe boxes rather than being charged by their bank. It won't go into the economy. It'll also be sitting in houses. So what's the point?
Okay, and just quickly before we round up with your thoughts for the rest of the year, Gwyn Matthews wants to know why buy-to-let is still perceived by the government, media and the city as a problem when in reality, for lots of landlords, it's their preferred pension. Jack Hayes wants to know whether you see buy-to-let as a better investment than stocks and shares. But then on the flip side, Dev Sopel from Utopia Financial Partners wants to know whether you think that property landlords will be penalised further for investing in property, in the sense that once we have to start paying back all this COVID debt, this is going to be one of the avenues Rishi's going to be going after. Very quickly, Tony, any thoughts?
Yeah, well, buy-to-let, I think you have to look at two things: the political view of buy-to-let, and then the central bank risk view of buy-to-let, and they're not always inextricably linked, in my view. So, politically, I think the government probably don't like buy-to-let. Why be associated with helping a relatively small amount of the number of the population in getting rich through owning properties or portfolios of properties that others can't afford to live in or buy and own themselves? So it's not a vote winner to support buy-to-let, is my perception. So government wouldn't necessarily mind hurting it some more, would be a negative view. Then you look at the Financial Policy Committee and the Bank of England, and they've had a bee in their bonnet about the buy-to-let market for years, and in particularly in recent years, that it's a higher risk asset, and there's no empirical evidence to support that at all. In fact, it's the opposite. It's over 26 years or whatever it's now been that buy-to-let as an asset class has existed. It outperforms the owner-occupied market in terms of performance, margins, arrears, and so on. So having said that, it's still perceived as higher risk by the FPC. They take views that, for example, if there's a downturn in the economy in the housing market, buy-to-let landlords will dump all their properties and therefore cause the housing market to become unstable. But actually, look at the last 12 months, that hasn't happened. We've seen other stress situations over the years when it hasn't happened. So,
okay.
Yeah, and I think the important point there that we sometimes forget is, in terms of the question about the importance of buy-to-let, while it's obviously a useful pension for landlords, its primary service there is to provide a housing need, rental accommodation for people that either can't or don't want to buy a property because they may be moving areas, they may want flexibility, etc. So it's important that we as an industry, that we keep on making that point, that actually there is a really important housing need for people that don't just want to buy, that they need a flexible housing market as well. But yeah, in terms of tax going forward, then property and all assets and wealth are likely to be targeted over probably income.
Yeah.
Okay, and perhaps we can end on a positive. Both Jonathan Smith and Emma Murphy are amongst dozens who want to know where you think the buy-to-let market's going to be in the next 6 months. So early summer 2021. Perhaps, how do you see the market panning out this year then? Tony, let's start with you.
Okay, this is in the realms of speculation, and there could be a number of outcomes, but I think I'm optimistic about the market, but I would counsel against us assuming it's going to go gangbusters. They're going to see massive growth. House prices are going to go herring away as well. So I would like to think that actually, even if we do have some sort of wobbles, as I described them earlier, we're going to come through this with the market pretty much intact. If we look forward another 12 months, I'm not looking to see massive house price growth during that time. I think if we come out of it on a sort of flat basis after all the ups and downs, that would be a good result. But fundamentally, I'm not looking for to see the market fall apart, I suppose, at all.
John?
So from my point of view, from buy-to-let, in terms of both the market, the broader market for landlords, in terms of rents, I think they'll hold up. I think property prices will tick up through the year. I don't think we're going to see 7-8% growth this year. But I think in terms of for intermediaries, the buy-to-let market, I think we'll see gross lending far higher than we've seen over any of the previous years. I think we will see, the remortgage market will remain strong, and we will see an improvement in the purchase market, mainly centered on Q1, but I think also in the second half of the year. So, and I'm happy to go out there. I think we'll see gross lending of over 42 billion this year, which will probably mean it's probably busier than even 2016.
Fantastic. Well, that is a positive end. And well, that does bring us to the end of this special Mortgage Introducer webinar in association with Lambay. Thank you to both John and Tony, and thank you for watching. You can also watch this broadcast again via various social media and also on the Mortgage Introducer website, which can be found at www.mortgageintroducer.com. I'm Robyn Hall, Publishing Director of Mortgage Introducer. Thank you, keep well, stay alert, and stay safe. Goodbye.
Bye.